Value investing, popularized by Warren Buffett, focuses on identifying undervalued stocks trading below their intrinsic value. Value investing is an investment strategy that involves finding stocks that appear to be trading for less than their intrinsic or book value. The core principle is identifying the gap between a stock's market price and its intrinsic value, what it's actually worth based on fundamentals. Value investors analyze financial statements and focus on key metrics such as price to earnings ratios, price to book ratios, and dividend yields. They seek companies with strong fundamentals, including consistent earnings, low debt levels, strong cash flow, and quality management. Value investors also look for companies with competitive advantages or moats that protect them from competition and allow for sustainable growth. Value investing is inherently a long-term strategy. Investors aim to hold undervalued stocks for years, even through market fluctuations, to realize their full potential. Growth investing is a strategy focused on companies with above-average growth potential. Growth investors focus on several key areas to identify promising opportunities. While value stocks show steady growth, growth stocks often display a much steeper trajectory in revenue and earnings. Growth stocks typically trade at higher PE ratios compared to value stocks, reflecting expectations of stronger future earnings. Growth companies often disrupt industries, challenging traditional players with innovative approaches and business models. The fundamental thesis of growth investing is that higher current valuations are justified by expectations of substantial future performance. Income investing is a strategy that prioritizes generating regular cash flow through dividends and interest payments. Unlike growth investing, which focuses on capital appreciation, income investing centers on creating reliable cash flow streams. Income investors typically focus on four main types of investments: dividend-paying stocks, real estate investment trusts or REITs, bonds, and preferred shares. Each of these vehicles provides regular income streams. Dividend stocks and REITs offer growth potential along with income, while bonds and preferred shares typically provide more stable, predictable payments. When evaluating income investments, there are several key metrics to consider. Dividend yield tells you how much income you're receiving relative to your investment. A sustainable payout ratio ensures the company can maintain its dividend. Consistent dividend growth helps your income keep pace with inflation. And a strong dividend history indicates reliability, with many income investors seeking companies that have paid dividends for at least 10 years. The primary advantage of income investing is the creation of steady, reliable cash flow. Dividend stocks can provide growing income over time, while bonds offer consistent, predictable interest payments. When combined, these income sources create a more stable total income stream, helping to protect against market volatility while providing funds for living expenses or reinvestment. Income investing is particularly beneficial for two main groups. Retirees often rely on income investments to replace their employment income, fund living expenses, and reduce the need to sell assets in market downturns. Others pursue income investing to create passive income streams, build financial independence, and fund their lifestyle or further investments without depleting principal. In this section, we'll explore momentum trading strategy, a popular approach among active traders. Momentum trading capitalizes on continuing market trends by buying stocks showing upward price momentum and selling those losing momentum. Let's look at how momentum traders identify opportunities in stock price charts. Momentum traders rely heavily on technical indicators. Moving averages help identify the trend direction and strength. Momentum traders typically enter the position when the trend begins to strengthen, often signaled by a moving average crossover, and exit when momentum starts to fade, avoiding the eventual trend reversal. Momentum trading relies on several key technical indicators that help identify and confirm trends. The moving averages identify trend direction and potential crossover signals. The Relative Strength Index, RSI, measures momentum and overbought oversold conditions. The trading volume confirms strength of price movement and trend. The MACD shows momentum changes and potential trend reversals. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. RSI values above 70 indicate overbought conditions, suggesting a potential reversal down. Values below 30 indicate oversold conditions. Momentum traders use RSI to identify potential entry and exit points, especially when combined with other indicators. Volume is a critical component in momentum trading. Increasing volume during price movements confirms the strength of the trend. Higher trading volume during price advances signals strong bullish momentum, while high volume during declines indicates bearish pressure. Let's walk through the typical workflow of a momentum trader. 1. Scan for stocks with strong price momentum. 2. Confirm trend with technical indicators. 3. Identify entry point when momentum builds. 4. Set tight stop-loss orders to manage risk. 5. Monitor for momentum weakening signals. 6. Exit when momentum fades or reverses. Let's examine both the advantages and challenges of momentum trading strategies. Momentum trading offers the potential for significant short-term gains with clear signals, but requires constant monitoring and can be subject to sudden reversals. Dollar-cost averaging is a systematic investment strategy where you invest a fixed amount at regular intervals, regardless of market conditions. This strategy involves investing consistently over time, regardless of market ups and downs. In this example, we're investing $500 every quarter, regardless of the current stock price. When prices are lower, you automatically buy more shares for the same dollar amount. When prices are higher, you buy fewer shares. By consistently investing the same amount, your average cost per share ends up lower than the average market price. This is because you automatically buy more shares when prices are low. Let's compare dollar-cost averaging with investing a lump sum at the beginning. While lump sum might outperform in consistently rising markets, dollar-cost averaging provides protection against poor timing and market volatility. Dollar-cost averaging really shines in volatile markets. When prices drop dramatically, you acquire significantly more shares at lower prices. Dollar-cost averaging works particularly well with index funds and ETFs, making it ideal for retirement portfolios. These investment vehicles provide broad market exposure and diversification, complementing the disciplined approach of dollar-cost averaging. To summarize, dollar-cost averaging offers several key benefits. It removes emotion from investing, eliminates the need to time the market, reduces the impact of volatility, provides a disciplined investment approach, and typically lowers your average cost in volatile markets. Contrarian investing involves deliberately going against prevailing market trends. While most investors follow the crowd, buying popular assets and selling unpopular ones, contrarians do the opposite. This strategy is based on the belief that markets often overreact to news and events. When positive news emerges, prices can shoot far above intrinsic value. Similarly, negative news can drive prices well below what companies are actually worth. Contrarians look to buy when assets are oversold and prices fall below intrinsic value. Conversely, they sell when assets become overvalued and overhyped. Contrarians look for specific opportunities that arise when market sentiment diverges from fundamental reality. They target solid companies facing temporary setbacks. While most investors flee, contrarians analyze whether the problems are solvable and the long-term business remains intact. Entire market sectors sometimes fall out of favor, creating opportunities to buy good companies at discounted prices simply because they're in unpopular industries. Market-wide panic selling during crashes or corrections often creates the best contrarian opportunities when even quality assets are sold indiscriminately. Contrarian investing requires exceptional psychological strength and patience. You need strong conviction in your analysis to withstand the pressure of market sentiment moving against you. Contrarian strategies often take time to play out. You may need to wait months or even years for the market to recognize the true value of your investments. To summarize contrarian investing philosophy, it's about deliberately going against market trends, buying undervalued assets, and selling overvalued ones. This approach requires strong conviction in your analysis and the patience to wait for the market to eventually recognize the true value of your investments. Index funds and exchange-traded funds represent two popular vehicles for passive investing. Let's understand what these investment vehicles are and how they differ. Index funds are mutual funds that track specific market indices like the S&P 500. They trade once per day at market close and sometimes require minimum investments. ETFs are similar to index funds but trade like stocks throughout the day, have no minimum investment requirements, and are often more tax efficient. Index funds and ETFs aim to replicate the performance of specific market indices, such as the S&P 500. When the market index rises or falls, the fund adjusts its holdings to match the composition of the index, ensuring that its performance closely tracks the market. One of the biggest advantages of index funds and ETFs is their significantly lower fees compared to actively managed funds. The fee difference may seem small, but over a 30-year investment horizon, a 0.9% difference in fees could reduce your returns by approximately $100,000 on a $100,000 investment. Research consistently shows that most active fund managers fail to outperform their benchmark indices over long time periods. According to S&P Dow Jones Indices, approximately 85% of large-cap funds fail to beat the S&P 500 over a 15-year period. A single index fund or ETF provides instant diversification by holding hundreds or even thousands of individual securities. For example, an S&P 500 index fund gives you exposure to all major market sectors, including technology, healthcare, financials, and consumer companies. Index fund and ETF investing makes sense for investors who want a low-maintenance approach focused on long-term growth while minimizing fees and taxes. This strategy is particularly appropriate if you prefer capturing market returns rather than attempting to beat the market through individual stock selection. Successful investors understand that market conditions are constantly changing. The market moves in cycles, alternating between bull markets characterized by rising prices and optimism, and bear markets with falling prices and pessimism. Each of these market phases requires a different approach to investing. The ability to recognize these cycles and adapt your strategy accordingly is what separates successful investors from the rest. During market downturns, successful investors adapt by taking a more defensive position. This typically involves increasing cash positions, which provides both protection and opportunity to buy assets at lower prices. Rotation to defensive sectors is another key strategy. These sectors typically hold up better during economic uncertainty and market volatility. They include utilities, consumer staples, healthcare, and treasury bonds. The primary goal during downturns is capital preservation while maintaining some exposure to assets that will benefit when markets recover. During bull markets, when economic conditions are favorable and markets are trending upward, investors typically shift to a more growth-oriented approach. This means reducing cash positions and increasing exposure to assets with higher growth potential. In bullish environments, sectors like technology, consumer discretionary, industrials, and small-cap stocks often outperform the broader market. These sectors benefit from increased consumer spending and business investment. While pursuing growth is important in bull markets, it's equally important to remain disciplined and not get caught up in market euphoria. Maintaining some defensive positions helps protect against unexpected market reversals. Successful adaptation requires regular monitoring of market conditions. Economic indicators like GDP growth, unemployment, inflation, and interest rates provide insight into the overall health of the economy. Technical signals like moving averages, relative strength, and volume can help identify short to medium term trends and potential reversal points. Market sentiment indicators such as volatility measures, fund flows, and analyst recommendations can signal excessive optimism or pessimism that often marks market extremes. Implementing a regular portfolio review process is essential. This should include quarterly performance assessments, rebalancing to target allocations, and strategic adjustments based on changing market conditions. While adapting to market conditions is important, it's equally crucial to maintain focus on your long-term investment goals. Successful investors make tactical adjustments within the framework of a strategic long-term plan. Remember these key takeaways. Adapt your tactics to current conditions while staying true to your strategic vision. Monitor meaningful economic and market indicators rather than reacting to headlines. And finally, maintain discipline through market cycles, the true secret to long-term investment success.